We are all welcome to One Touch Professional School. We are continuing our discussions on financial accounting, paper 1.1. In our previous discussions, we've looked at from unit 1 to unit 3. Today, our discussions is centered on chapter 4, which is the double entry bookkeeping. Now, let's look at the course overview or the chapter. What are we expected to know? What are we expected to know? One, we should have an appreciation of what is meant by bookkeeping. Bookkeeping. We also look at the basic rules of double entry bookkeeping. Then we'll move on to account balances and the trial balance. And finally, we'll look at the general journal. The general journal. Great. Now, bookkeeping. Bookkeeping. When we talk about bookkeeping, it simply refers to the process of recording financial transactions in the accounting records, that is, the books of an entity. All transactions are analyzed. All transactions are analyzed into different types and are then recorded in a series of individual records called accounts. There is a separate account for each different type of transaction or each type of asset, liability, income, expense, and owner's what? Capital. Accounts are kept together in a ledger. So a ledger simply is a term meaning a collection of related what? Accounts. Good. So when we talk about bookkeeping, we are saying that it's the process of recording financial transactions in the accounting records. That is the books or the book of an what? Entity. So we have accounting records, okay, or books of accounts. Okay, great. So all the transactions will be analyzed into different types and are then recorded in a series of individual records called what? Accounts. And we are stating here emphatically that there is a separate account for each type of transaction or for each type of what? Asset. Okay, liability, income, expense, and owner's what? Capital. Okay, great. So basically, every single transaction that occurs in a business, okay, is recorded. Okay, don't forget that we said that under the accounting equation, we did mention that every single accounting transaction must be recorded twice in the books, one as a debit and one as what? As a credit. Or one is that it may affect either cash or it will cause an asset to increase or a liability to decrease, or an increase in one asset or a decrease in another asset. Okay, good. So every transaction that occurs needs to be recorded, and that transaction too should have two effects. Okay, a debit and a credit. Great. Now, with this in mind, then let's look at the basic rules of double entry bookkeeping. The basic rules of the double entry bookkeeping. Good. Now, here we'll be introduced to terms like debits, credits, and the T accounts. When we talk about debits, or when you hear of debits, what does it mean? When you hear credit, what does it mean? When you hear a T account, what does it represent? Great. We'll also look at the rules of debits and credits. Okay. Then finally, we'll look at the double entry bookkeeping and the cash account. The double entry bookkeeping and the cash account. Good. Now, debits and credit entries and the T accounts. Now, the following rules apply to the account in the main letter. That is the nominal ledger, or the general ledger. Now, every transaction is recorded twice, as a debit entry in one account and as a credit entry in another account. Total debit entries and total credit entries must always be equal. This maintains the accounting equation. Okay, this maintains the accounting equation. Once one account is debited, another is credited. Okay, now the sum of the debit entries and the sum of the credit entries, okay, should be equal. Because when we're looking at the accounting equation, we said that assets of a business, okay, is equals to what? Capital plus what? Liability. Okay, good. Now, we did mention that the assets, okay, A is equals to C plus L. Okay, where A represents assets, and you can see that A is on your left hand side, and capital and liabilities is at the right hand side of the equation. Okay, good. So we said that assets of a business is equal to what? Capital plus liabilities, and here we are making use of every transaction should be recorded twice, as a debit entry in one account and as a credit entry in another account. Again, we are emphasizing that the total debit entries and the total credit entries must be what? Equal. And that debit and credits, okay, then maintains the accounting equation what? Assumption, which is the assets of a business is equals to its capital plus what? Liabilities. Good. Good. It therefore helps to show accounts in the shape of what? A T. It therefore helps to show accounts in the shape of a T, with a left hand and a right hand what? Side. Okay. This is popularly known as the T account. This is popularly known as the T account. By convention, by convention, debit entries are made on the left hand side and credit entries are made on the what? On the right hand side. So if you look at the accounting equation carefully, you can say that there are two sides. We have the left hand side representing assets and the right hand side representing capital and what? Liabilities. Okay, good. So if you are going to keep this in a T shape, you are saying that this T shape again takes the form of the accounting what? Equation. Good. Good. Give me a second. Good. So basically, this is what we are looking at. Now, good. Good. So now, let's continue our discussions. Now, we are looking at the rules of debit and credit entries in the T account. We have already mentioned that when the total debit entries and total credit entries must always be equal. And this maintains the what? The accounting what? Equation. Because we did mention that assets, okay, assets is equals to what? Capital plus what? Liabilities. Okay, good. So here on this, in this equation, you can see that we have a left-hand side and we have what? A right-hand side. Good. Now, from our discussion, we have already indicated that it therefore helps to show accounts in the shape of a T with a left-hand side and a right-hand side. And this is popularly known as the T account. Okay, good. So a normal account is shown like this. It's shown like this. So this is our T account. This is our T account. Good. That's our T account. And we've also indicated that debit entries are made on the left-hand side. So if you look at this T account, this is the left-hand side. And so this side is referred to as the debits. It's referred to as the debits and properly denoted by DR. DR, representing debits. Okay. The middle of it will take the what? The account name. The account name. The account name. Okay. Then this side, which is the right-hand side, is the what? Is the credits. Is the credits denoted by CR. Okay, good, good. Now, so let's see the kind of items or the kind of transactions that could be recorded in this T account. Good. So we are saying that the debit entries are made on the left-hand side and credit entries are made on the right-hand side. Okay, good, good. So if you look at our T account here, okay, we have the account name, we have the currency, then we have our debit, and we have what? Credit. Okay, good. We are saying that debit transactions entered on this side. Debit transactions are entered on this side, which is the left-hand side. Okay, good. The left-hand side records debit transactions. Good. And you again enter reference to the account where the matching credit entry is made. So assuming you are recording a transaction on the debit side of an account, because we have mentioned that every transaction must have two effects, okay, a debit and a credit. We are saying that the debit will take place in one account and the credit will also take place in another account. So when recording the transaction on the debit side, okay, you will enter the transaction on the debit side with reference to where the corresponding credit entry will be what? Will be found. Okay, will be found. Good. Then when you record transaction again on the credit side, okay, so the credit transactions are entered on the right-hand side. And when you are recording a credit transaction, you record that transaction by making reference to where the corresponding debit entry will be what? Will be found. Okay, good, good. So for example, XYZ Limited paid the company's annual rent in cash amounting to 2,000 Ghana cedis. Good. Now, if you are asked to record this transaction in the T account or the various letter accounts, good. We are saying here that XYZ Limited paid the company's annual rent in cash amounting to what? 2,000. So here there is a payment, okay, and the payment is in respect of what? Rent. Okay, it's in respect of what? Rent. Okay, and we paid the rent in what? In cash. Okay, in cash. Okay, so it will also involve cash. Now, how do we show this on the T account? So let me open my T account. Let me open another one here. Great. So one will be for rent. One will be for rent. I have my credit, I have my debit. And one for what? Cash. I have my credit, I have my debit. Now, XYZ Limited paid the company's annual rent in cash amounting to 2,000. What does it mean? If you pay money, it means that your cash available will reduce. Okay, good. And you have created what? An expense, because you have paid for rent, and rent is an expense. Okay, and as you are paying, okay, you'll be giving out money. Okay, good, good. So now we said that record the debit transaction by making reference to where the corresponding credit to be found. Okay, good. So let's assume, okay, that when rent is paid, okay, rent is an expense. Okay, rent is an expense. Okay, so our expense will go up. Okay, and our cash will reduce. Okay, good, good. Now, before I come to this and show the entry, let's look at the next thing to look at. That will give us an understanding so that we know what to debit and what to credit. Okay, great. So let's continue. Let's continue from our lecture notes. Good. So let's look at the rules. The rules of debits and credits. Now, in the main ledger, there are accounts for assets, liabilities, equity, income, and expenses. The rules about debit and credit are as follows. Good. So you see the debit side, okay, denoted by our DR. We see our credit side denoted by our CR. We see our currency. Good. Now, the debit side. Now we are saying that record as a debit entry. Record as a debit entry an increase in assets. Good. So it means that when an asset is increasing, we need to what? Debit it. When an asset is increasing, we need to what? Debit it. Again, we say that an increase in an expense, record as debit entry, an increase in an expense. It means that when an expense is incurred, we do what? We debit it. Okay, good. Paid electricity, 5,000 in cash. Electricity is an expense to a business. So if you are paying, it means that you are creating an expense, and that causes the expense to increase. So it means that when an expense is incurred, it needs to be what? Debited. That's what the rules, okay, is telling us. Okay, good. Now, again, record as a debit entry a reduction in a liability. Now, we are saying that whenever a liability is decreasing, we need to what? Debit it. For example, you've gone for a loan from a bank. Okay, good. Now, when you go in for a loan from a bank, it means that as a company, you'll be receiving money. Is that not it? Good. So the money that is coming in, okay, from the loan that you have contracted from the bank, okay, it's an increase in assets. Is that not it? Because when you go in for the loan, you get cash. Okay, cash is an asset. It means that when an asset is increased, what do? Record as debit entry an increase in what? An increase in what? Assets. Okay, so meaning that when you go in for a loan from the bank, the amount of cash that is coming in, right, needs to be what? Debited. Okay, good. Once you have gone in for a loan, it means that you'll be indebted to the bank. Okay, you'll be indebted to the bank. Okay, great. That is what? A liability. So we look at how to record a liability. Do we debit a liability when it is increasing, or do we credit a liability when it is increasing? Okay, good. So let's see. We are saying that record as a debit entry a reduction in a liability, meaning that when a liability is decreasing, you need to what? Debit it. For example, paid the bank loan. Okay, initially I did mention that went in for a loan from a bank. Now you are paying the loan. So if you are paying the loan, it means that money will be going out of the business. Okay, good. So your cash will reduce. Okay, but we said that when an asset is increasing, we debit. So when it is decreasing, when an asset is decreasing, what do? We will credit it. We'll come to that in a bit. Again, record as a debit entry a reduction in income, meaning that when an income is decreasing, we need to what? Debit that account. Good. Then a reduction in capital, that is as a result of drawings or losses. It means that when capital is also decreasing, it needs to be what? Debited. Good. Now let's look at the credit side. Transactions that we can record on the credit side, okay, of an account, okay, or what the credit side of an account can be used for. Good. Now the credit side, we say that record as credit entry a reduction in an asset, simply meaning that when an asset is decreasing, we credit it. Okay. Now record as credit entry a reduction in an expense, meaning that when an expense is also decreasing, okay, we do what? We have to credit it to that expense account. Then record as a credit entry an increase in a liability. That is when a liability, okay, is incurred, or when a business incurs a liability, okay, that liability is credited. That should tell you that liabilities are what credit balance. Because when we look at the accounting equation, what did we say? We said that the assets of a business is equals to what? Capital plus what? Liabilities. Now, if you look at this equation carefully, you can see that there's two sides to the equation. We have the left-hand side, and we have what? The right-hand side. Okay, good. So clearly you can see that the left-hand side is the what? Is the debit. And the right-hand side is the what? Is the credit. Okay, good. So this conforms to the T account. Good. Now, an increase in income, record as credit entry, an increase in income, meaning that when an income is increasing, we need to credit that income what account. Then an increase in capital by way of capital introduced, and when profit is what is made. Okay, good. So it means that when an equity, or when the owner's equity or capital is introduced into a business, it needs to be what credited. Okay, good. Again, take very good note of the elements of a financial statement, because here we are mentioning assets, we are mentioning liabilities, we are mentioning income, we are mentioning expense, we are mentioning what? Equity. Now, the increasing, or the increase in value of the item, okay, tells you something. Good. Now, in our next session, you begin to understand what I'm trying to mean by when an account is increasing, it denotes something. Okay, the parts or the side in which an increase in asset is recorded, okay, or an increase in liability is recorded, tells you the balance or the position where the final figure for that element of the financial statement will be. Good. So let's see. Just a brief recap. So what that we are saying here is that when there's an increase in assets, or when assets are increasing, you need to debit it. Simply meaning that record it at the left-hand side of the account. Okay, good. When an expense is also increasing, we say we have to debit it. Okay, meaning that we should record it at the left-hand side of that expense account. Okay, good. Again, the debit side, okay, could also be used to record a reduction in liability, meaning that when a liability is decreasing, we need to debit that liability account. Okay, now when there's a reduction in income, okay, that decrease in income should be recorded at the left-hand side of that income account. Okay, good. And when there's a reduction in owner's equity, that decrease should also be recorded on the left-hand side of that equity account. Okay, good. However, when there is a reduction in assets, when an asset is decreasing, okay, we need to credit that asset account. Okay, good. And when there is a reduction in expense, okay, the reduction in expense should also be credited or be recorded on the right-hand side of that expense account. Good. And when a liability is increasing, now we are saying that we should credit it to that liability account. And when there is an increase in income, when an income increase, the increase in income should also be what? Credited. Okay, and when there is an increase in owner's equity, it should be recorded also at the credit side of the account. Okay, good. So the whole discussion on the T account centers on the elements of the financial statement, which are basically assets, liabilities, owner's equity, income, and expense. So we are looking at the effect of transaction on this element of financial statements. Okay, good. So let's look at this. Let's look at our earlier example. Good. Now, what did I say? XYZ Limited paid the company's annual rent in cash amounting to what? 2,000. Good. Now, what does it mean? If the company paid rent, right, it means that there is going to be what? An increase in what? In expense, which is what? Rent. Okay. So this transaction is going to lead to what? Is going to lead to an increase in expense, which is rent, by what? 2,000 Ghana cedis. Okay. And going to again lead to what? A decrease in assets. That is what? Cash, by again 2,000 Ghana cedis. So per the rules of debit and credit, what did we say? Record as a debit entry an increase in assets, an increase in an expense. So by paying for rent, there's an increase in what? Expense, which is what? Rent. So this is how our T account will look like. So we have the rent account. We have the rent account. Okay. We have the credits. We have the debits. We have our CD sign. And we are told that when there is an increase in an expense, okay, or we should record as debit entry an increase in expense. And we have earlier learned that when we are debiting a transaction, we should debit it by reference to where the corresponding credit entry will be what? Will be found. So in this account, we need to debit what? Rent. So we are debiting rent in the name of where the corresponding entry will be found. And where the corresponding entry will be found is what? Is the cash account. So you debit rent in the name of what? Cash. And the amount is what? 2,000. Good. When you are done, then you have to open the corresponding what? Entry. And here it is the what? The cash what? Account. It is the cash account. Good. And that we have our debit, we have our credit, we have our CD sign. Okay. So here there's a decrease in an asset, and we said that record as credit entry, a reduction in an asset. Cash is an asset. So asset is decreasing because money is going out. So once money is going out, we need to what? Credit it, because it's a reduction in the amount of cash. So we come here and we indicate what? Rent, because the reference, we are crediting it by reference to where the corresponding debit will be found. And the corresponding debit will be found in the rent what? Account. So we credit cash in the name of rent, and the amount is what? 2,000. I hope you are following. Great. Great. So that is what we are looking at. Okay, good. 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 So now let's look at double entry bookkeeping and the cash account. Double entry bookkeeping and the cash account. Good. Now, an entity would usually keep separate accounts to record cash. One is for cash in hand, and the other is for cash at what? At bank. Okay, because we know that every business, okay, keeps a bank account. Okay, so as and when they receive cash at their premises, that money is remitted to the what? To the bank. Okay, good. So now, the double entry for transaction involving the receipt or payment of cash into the cash at bank account or cash in hand account are recorded as follows. So this is how the movement in a cash in hand or cash at bank account is recorded. Okay, good. Now we are saying that the cash at bank account is an asset account. That's money in the bank. It's an asset. Now, receipt of cash, these are recorded as debit entry in the cash at bank account because receipts add to cash, meaning that when the business receives money, or receives cash, Okay, now that amount of money received, we say that we record it as a debit entry because it is causing an increase in an asset. Good. And don't forget that we have already mentioned that we record as debit entry when there's an increase in what? In an asset. So when cash is received, cash is an asset. Okay, so it needs to be what? Debited. Now, payment of cash. Payment reduce cash. So these are recorded as a credit entry in the cash at bank account. Okay, good. When you part way with money, it means that your money available will reduce. So as cash is reducing, and since cash is an asset, it needs to be what? Credited. Okay, good. So just as I illustrated here, when the company paid their annual rent of 2,000 by cash, you saw that there was a reduction in cash. And as cash was reducing and cash is an asset, you can see that we credited cash in the name of what? The rent. That is where the matching what? Debit will be found. And the matching debit is found in the rent account. And there too, you see the name of what? Cash. Because what this means is that when you go into the cash account, you will see rent. Okay, good. So this is how a cash transaction should be what? Recorded. When there is an increase in cash, you debit. When there is a decrease in cash, you what? You credit. Good. So let's look at the basic rule for recording transaction in a cash at bank account or cash in hand account. Good. Now we said that the debit side. So here we have the debit side and we have the credit side. Okay, good. Now record as a debit entry. Now, transactions that provide an increase in cash. So it means that any transaction that causes cash to increase needs to be what? Debited. Now, the matching credit entry might be two. For example, one, sales accounts for what? Cash sales. When the business sells goods for cash, cash will be coming in. Is that not it? Good. So as cash is coming into the business, the cash account needs to be what? Debited. Okay, good. And the corresponding credit entry will be to the what? The sales account, because the what is causing the increase in cash is what? The sales made. Good. Again, it could be as a result of what? Total trade receivables what? Account. Why? Because when you sell goods on credit to your customers, the customers take some time before they come and what? Pay. So when you receive money from your debtors or from your customers, okay, good, the money is adding to your cash available. So it is causing an increase in the cash. Okay, so when money is received from debtors, it also causes cash to increase. So that receipt of cash from the debtors needs to be what? Debited. And the corresponding credit entry will be found in the what? The trade debtors what? Account, or the debtors what? Account. Good. Another thing that can cause an increase in cash is when the capital account for new capital introduced. When the owners of the business introduce capital into the business, okay, that introduction of capital will cause cash to what? Increase. So as cash is increasing, we need to what? Debit it. Okay, and here the corresponding entry will be found in the capital account. I hope you are together. Good. Now again, we say record as credit entry transactions that result in a reduction in cash. Meaning that when cash is reducing, the cash account needs to be what? Credited. For example, now the matching debit entry might be to one, an expense account for payment of cash what? Expenses. Now, a typical example is this example where the company paid its annual rent in cash. Now, we saw that there was what? There was a reduction in cash. So what do? We credited the cash account. Okay. Now, where was the corresponding debit entry found? We said that the matching debit entry might be to one, an expense account for payment of cash what? Expenses. Yes. So you can see that in the rent account, you see cash. So the corresponding entry of the reduction in cash was found in the rent what? Account as a debit. Okay, in the rent what? Account. Good. Now again, a reduction in cash will mean the matching debit entry might be found, okay, in the total trade payables account for payment to suppliers for purchases on credit or amount owing. What do we mean? When we also buy on credits, okay, good. It means that if it is for trading items, okay, when we buy goods that we retrade or we resell, now that denotes purchases. So when we buy, okay, our purchases will go up, but because we did not pay, there will be an increase in our liabilities. Okay, there will be an increase in our liabilities. Okay, so when we make payments for that amount that we owe to our suppliers, okay, now there will be a decrease in the amount of cash in hand or at bank. Okay, and the corresponding entry will be found in the trade payables account, because when a liability is increasing, we credit it. So when we buy goods on credit from suppliers, the goods is coming in. Goods denote purchases. Purchases is an expense. So since an expense is increasing on purchase of goods, we will debit the purchases. Okay, when we debit the purchases, the corresponding entry is to credit the suppliers. Okay, good. Now on payment to the suppliers, there will be a decrease in your cash. Okay, which you credit. So the debit will be found in the suppliers account. Good. Good. Again, now payment in cash for a new asset. So let's assume that XYZ Limited, okay, XYZ Limited purchased an office equipment amounting to 5,000 Ghana cedis in cash. Okay, good. So XYZ Limited has acquired an asset, or they have purchased an asset. Okay, good. Now it means that there has been an increase in assets. Is that not it? And what did our rules tell us? Our rules says when there is an increase in assets, we debit it. Is that not it? Good. So here we open the office equipment account. Office equipment account. Okay. Good. And we open our cash account as well. Good. So we should indicate our debits, should indicate our credits, indicate our debits, indicate our credits. So on purchases of the office equipment, an asset is coming into the business, right? Which is an increase in assets. So we debit the office equipment in the name of what? Cash. 5,000. Okay. Then cash is reducing. So we credit it in the name of what? Office equipment. Office equipment. And the amount is what? 5,000. So that is a reduction in cash. And the reduction in cash could be as a result of payment in cash for a new asset. And again, drawings account for withdrawals of profit by the business owner could also cause a decrease in in cash. Good. That is excellent. Now let's see. Let's continue our discussion. Let's continue our discussions. Now let's take a question. Let's take a question and see how we will go about the entries. Good. Good. Now, illustration. Now it says that the following transaction relates to some enterprise for the year ended 31st December 2018. January 1, Sam decided to set up a business selling football shirts from a store in the marketplace. He begins by introducing 30,000 into the bank account for the business. He begins by introducing what? 30,000 into the bank account for the business. Good. So now always when you get a question, always look at the requirements. Okay, good. So yeah, what are we required to do? We are required to post all the transactions to the ledger hot account. To the ledger hot account. Good. So let's see. Good. So the first transaction is that Sam decided to set up a business selling football shirts from a store in the marketplace. He begins by introducing 30,000 into the bank account for the what? For the business. Okay, good. Sorry. Let me divide the board. Good. So let's look at how to record the first transaction. How do we record the first transaction? Sam decided to start up a business selling football shirts from a store in the marketplace. He begins by introducing 30,000 into the bank account for the business. So it means that Sam has introduced a capital, okay, and introduced what? 30,000 into the bank account. So it means that the amount of money at the bank will be what? Increasing. Is that not it? Good. And the amount or the transaction giving rise to the increase in bank is what? The introduction of what? Capital, which is one of the elements of a financial statement. Good. So let's see. So it means that we have to open for the first transaction, that is January 1. January 1, I have to open my what? My bank account. Okay, my bank account. I have to open my bank account. Good. So I have my credit side, I have my debit side. Okay. Good. Then again, I should open my capital what? Account. Of my capital account as well. Of my capital account as well. Okay, great. Now I want to have my debit side, I have my credit side. Good. So he introduced 30,000 to the bank account, right? So bank will be increasing. So let me put my CD sign here. So don't forget, always there's a need for you to record your what? Your date. So this transaction occurred in 2018. So let me put my date here, 2018, 2018, 2018. Good. So cash will be increasing, or bank will be increasing. The transaction was on the 1st of okay, so 1st of 12, and bank is increasing the name of what? Capital, and the amount is what? 30,000. Good. Then you come to the equity or capital accounts. Now, capital has been what? Introduced. Okay, and it means that capital will also be what? Increasing. And we said that we should what? Record as credit entry. We should record as credit entry Um, I'm looking at the rules of debit and credit. Record as what? Credit entry, a reduction in assets, a reduction in an asset, an increase in liability, an increase in income, an increase in capital, what? In the form of capital introduced or what? Profit. Is that not it? So here capital is increasing. Okay. So on the same date, which is 1st of December, we have bank, and the amount is what? 30,000 as well. I hope you are following. Good. So let's go back to our question. Let's go back to our question and continue from there. Good. Good. The next transaction is that on January 15, Sam borrows 40,000 from his brother to purchase a van for the what? For the business. Sam borrows 40,000 from his brother to purchase a van for the business. So how do we record this transaction? Good. Now, first, he borrows 40,000 from his brother to purchase a van, meaning that when he borrows, the brother will give the money to him first. Is that not it? On receipt of the money, that is when he will go and what? Buy the asset. Is that not it? Good. So this will have 4 effects. First, let's look at the borrowing of the money. On borrowing, okay, some will receive money. So we have loan. So there will be a loan and there will be bank. But because you already have the bank account, okay, I don't want us to open a new bank account, okay, because under exam condition, all the transactions must be recorded in one account. So if a transaction affects bank, you should continue in that bank account. You don't open a separate bank account for every single transaction. You get the point. Good. So here I'm continuing from this bank account. But the next one is the what? Is the loan. Because when you borrow, okay, you create what? You receive loan. Is that not it? And the loan is a liability. Okay, good. Because you'll be indebted, some will be indebted to the brother. Okay, good. So here, let me open my loan account somewhere here. Loan account. Okay. So this is 2018. Good. So on borrowing, that is 15th. Oh, sorry, it is in December. I'm looking at December. It is okay. Sorry. So here should be 1st of January. Okay. It should be 1st of January. Good. So I come here on the 15th of January. On the 15th of January, there's a loan, and that is what? 40. So that adds to my amount of money at the bank. Then there is a loan. So I've debited bank. So what do? I need to credit the loan account. So on the 15th of January, I have here bank. And the amount is what? 40,000. Good. Now, he borrows 40,000 from his brother to purchase a van for the business. So on acquisition of the van, there'll be an increase in an asset because van is an asset. Okay. So you need to also open the van account. Van account. You need to open van account. So we have debit, we have what? Credit. Good. He purchased van. So meaning that when he buys the van, okay, what will happen? We'll be paying. Okay, he borrowed the money, to purchase a van for the business. It means that the amount of money borrowed was used to purchase that van. So the money will now move from the bank account, because when we buy, we must pay for it. Good. So what we will do here is that we are going to credit on the same 15th of January, we'll credit the bank in the name of van, because the amount of money borrowed will be used in purchasing the van. Then that van should add up to the motor vehicles or the vans that the business has acquired so far. Okay, so cash will be reducing, whereas there will be an increase because the van will be coming into the business. Okay, good. So in the name of bank, then the van of what? 40,000. I hope you are following. Good, good. So let's look at our next transaction. The next transaction is on the 25th. Okay, 25th. Sam buys a market store and pays 5,000 in cash. Sam buys a market store and pays 5,000 in cash. Okay, good. So Sam has acquired or purchased a market store. Here we said that Sam decided to start a business selling football shirts from a store in a market place. So once he's bought the store could be seen as the assets of Sam, because that would be the premises or the shop from where he'll be operating from. So the store could be seen as an asset to Sam. Okay, good. So and he buys it and pays 5,000. So meaning that there will be a reduction in our cash account. Is that not it? Good, good. So here again on what date? On the 25th. So 25th of January. In the name of store, the amount is what? 5,000, because cash will be reducing, or the cash at bank will be reducing. Good. Then we open our store account. So we have credit, we have debit. Okay, good. So 2018, our CD sign. This occurred on the 25th of January. So we have bank. The amount is what? 5,000. Good. 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 All right. Now let's look at the next transaction. February 10th. Sam buys some football shirts for 18,000. These shirts were bought on what? On credit. Good. Now I want to do this side by side. Okay. So what I'm going to do is that I'm going to create a new board for you to see. Okay, good. Good. So I'll be using this one just to make sure that I have all the transactions side by side. Good. Good. The next thing is that Sam buys a market store that has been recorded. On the February 10th, Sam buys some football shirts for 18,000. These shirts were bought on what? On credit. Good. So now Sam deals in the sale, buying and selling of football shirts. So anytime he buys such items for resale on purchases, okay, that denotes what? Purchases. Okay, the kind of item that an entity trades in, okay, is termed as what? Purchases. Okay, good. So whenever the entity buys the items that they trade in, we term it as what? Purchases. Okay. Okay. So now he buys football shirts for 18,000. These shirts are bought on what? On credit. Now, when you buy on credit, it means that you'll be indebted to your what? Your supplies. Is that not it? Good. So in this transaction, in this transaction, you are going to open our purchases what? Account. Okay, you are going to open our purchases account. So we have our credit, we have our debit. Then I'll open the purchase. But this shirts were bought on credit. So on credit purchases, you create what is called trade payables. Trade payables because you are indebted to your suppliers, those who supply you the goods that you trade in. Okay, so you buy on credit, you sell, and later go and pay them. So trade payables accounts. Okay, good. So here on purchases, there is an increase in the expense because purchase is an expense. Okay, good. So here we come here on the 10th of February, we have trade payables. I'll put my CD sign here. The amount is what? 18,000. Then I come into the trade payables accounts. Since you'll be owing them, that's a liability, and an increase in liability is credited. Okay, so on the 10th of February, I have here purchases of what? 18,000. Good. I trust you are following. Good. Now, let's look at February 16. Sam pays 10,000 to his suppliers for some of the shirts he purchased. Sam pays 10,000 to his suppliers for some of the shirts he purchased. Good. So now Sam is making repayments. Okay, good. So when Sam pays, what happens? There will be a reduction, okay, in an asset, which is what? His cash at bank will reduce because money will be going out of that account. Okay, good. And again, there will be a reduction in the amount of his indebtedness to his suppliers because he's paid some. He owes them 18, and now he's paying 10,000 out of it. Okay, good. So you come here, okay, that's on 18. There's a reduction in liability. Now, when there's a reduction in a liability, we debit it. Good. So you come here on the 16th of February in the name of bank. Okay, in the name of bank, 10,000. Okay, good. Now let's go into our bank account. Okay, let's go into our bank account. Good. So this is our bank account. Okay, so now there's going to be a reduction in the bank account. So on 16th of February, in the name of what? Trade payables. The amount is what? 10,000. It has reduced. I hope you are following. Good. Because Sam pays 10,000 to suppliers for some of the shirts he purchased. Okay. Now, when he bought the shirts, Sam didn't pay. So that landed Sam to be indebted to the trade suppliers. Okay. Now he's paying. As he's paying, money will be going out. So there'll be a reduction in an asset, cash. Okay. And as cash is reducing, cash needs to be credited. Good. So let's go back. Great. So let's look at the next transaction. February 28th. Sam sells 50% of the shirts, okay, for 12,000 in cash. Sam sells, okay, 50% of the shirts, okay, for what? 12,000. Okay, good. So now, on sale of the shirts, okay, what happens? sells 50% of the shares for 5,000 in cash. So it means that on sale, okay, cash will be coming in. Okay, there'll be an increase in assets cash because we received money for the sale. And what did we sell? We sell inventory. Okay, we sell some of the goods that we purchased. Now, so what is causing the increase in cash? It is the sales what made. That is the income. Don't forget that sales is one of the elements of a financial statement. Okay, and we said that when there's an increase in income, what do? We need to credit it per the rules of double entry. Okay, good. Let's revisit it. Let's visit it. Good. So these are the rules of what? Debit and credit. Now, record as credit entry a reduction in an asset, a reduction in an expense, an increase in liability, an increase in income. So on sale of goods, now we say that some sold 50% of the shares for 12,000 in cash. So on sale, it means that there will be an increase in our income because you have made a sale. Okay, good. And the sale made is resulting in the receipt of cash. So the amount of money at the bank will also increase. Good. So here we will. Let's go back to our question. Let's go back to our question quickly. Good. So we open our sales account. We open our sales account. So credit, debit. Good. So on sale, we received cash. Okay, so it means that there is going to be an increase in asset cash. Okay, and when there's an increase in assets, we say what we should debit. Okay, now then on sale, it is the sale that result in the increase in cash. So it means that sales needs to be what? Credited because an income. Okay, so we record as credit entry an increase in income. So we come here on we are in 2018. The date is 28th of Feb. So in the name of bank, because we received cash for the sale, that is 12,000. Okay, that is 12,000. Okay, so we go into our bank account and debit it in the name of sales. Also what? Good. So this is our bank account. Cash is coming in, so we debit. So on the 28th of February, I see sales. How much? 12,000. Good, good, good. So let me go back to my new. Great. Now on April 8th, Sam sells shirts for 9,000 to a shop owner in another town. These shirts originally cost 5,000. He sells the shirt on credit, giving the purchaser 1 month to pay. Okay, good. So Sam sells shirts for 9,000 to a shop owner in another town. These shirts originally cost 5,000. He sells the shirt on credit, giving the purchaser 1 month to pay. Good. So here, our focus is on the sales. Okay, our focus is on the sales. That's what I'm focusing on. Don't forget that this is the same example we used for the accounting equation. Okay, good. However, in this illustration, we are looking at how these transactions will be recorded in the what? In the ledger account. Okay, good. So our concentration here is on the sales made. Good. Now, on sale, the sales were made on credit. And whenever you sell on credit, you create what? Debtors, because the customers will be indebted to you. Okay, because you didn't receive money. So the account to keep is what? The trade debtors what? Account. So that at any time you can monitor. Okay, because cash was not received, you need to create an account to hold the indebtedness of your customers so you can track or follow up. Okay, good. So on sale of goods on credit, you create what? Debtors. So we open our trade debtors, or let me call it trade receivables. Trade receivables account. So we have our credits, we have our debits. Good. So the sales, okay, now, so it means that goods will be going out, right? And you'll be creating debtors. So the debtors will be coming in. They are now indebted to us. Okay, good. So they are assets. So trade receivables is an asset. So record as debit entry an increase in assets. So you come here, 2018. This is 8 of 4, 8 April. So in the name of what? Sales. And the amount is what? 9,000. 9,000. The amount is 9,000. Good. So I come here on the 8th of April. We have trade receivables. The amount is what? 9,000. Good. Good. I hope you are following. Good. Good. Now let's look at April 20th. Sam repays 10,000 of the loan. Sam repays 10,000 of the loan. Good. Now, let's see. Where is the loan account? Come here. Good. Good. So we have the loan here. Sam repays 10,000 of the loan. Okay. Good. Now, on repayments, there will be a reduction in assets cash because cash will be going out. Is that not it? And we said we record as credit entry a reduction in an asset. Okay. So we come here on the 20th of April. We say loan. The amount is what? 10,000. They are repaying. Then you come into the loan account because once you are paying, originally we borrowed 40, so it needs to reduce. Okay, so we record as debit entry a reduction in a liability. So we come here on the same 20th of April. I have bank here, and I'm debiting it to what? 10,000. I hope you are following. Good, good. Good. Now the next transaction is June 15th. June 15th. Sam pays his trade suppliers 6,000. Good. Don't forget that Sam purchased some goods from his trade suppliers on credits amounting to 18,000. Okay. Good. So let's see. Let's go into that. Sam pays his trade suppliers 6,000. Now on payment of his supplies, his bank balance will reduce, or his cash what will reduce. Is that not it? Good. So you come here on what date? On June 15th. So 15th, 6th. So we have trade payables of what? 6,000. Good. 6,000. Good. So we go into the trade we come into the trade payables account. Good. So we have credited cash or bank account. So we come here and we debit the trade payables account because we record as debit entry a reduction in a liability. Trade payables is a liability because some bought goods from them on credit and didn't pay. So some will be indebted to them. Okay, so as some is paying, Sam's cash will reduce. So that will be a credit. So the corresponding should be a debit. Okay, so we come here. That is 15th of 6. We say bank, and the amount is 6,000. Great, great. Now, the next transaction, September 18th, Sam receives 8,000 of the money owed to him by the customers. So it means that now Sam's customers are paying Sam. So the amount of 8,000 is coming in. Okay, they are paying. So that will be received. Okay, and that will be recorded in there will be an increase in an asset, that is what? The bank, because the money will be coming into the business. Okay, good. And what that means is that the amount of indebtedness of the trade debtors will reduce. Good. So we come here. Once you have received money, the money will reduce their debt. So on the 18th, 18/9, we have what? Bank. And the amount is what? 8,000. Great. It's 8,000. Good. So we go into the bank account. Let's enter this also in the bank account. Let's enter this in the bank account. Good. So this is the bank account. So on 18th of September, that is trade receivables. That is 8,000. I hope you are following. Good. Now, to the final transaction. Sam purchases another 5,000 of shirts on credit. So when Sam buys shirts, don't forget that shirts is his trading stock. So anytime he buys, it denotes what? Purchases. Okay. Purchases represent goods purchased for what? Resale. Okay. Good. Great. And it was on credit. So that will affect purchases and trade payables accounts. Good. So on 30th 12, we have trade payables. We have trade payables. And the amount is what? 5,000. Good. And this increases the trade payable account. So this is it. On 30th of December, I have purchases. And the amount is 5,000. Good. So this is how transactions are recorded in the ledger account. This is how transactions are recorded in the ledger account. Good. Now let's move on. Then let's look at account balances and the trial balance. Account balances and the trial balance. Good. Now, in this session, we are expected to know how to close off an account and bring down the balance, and how to extract a trial balance. Okay. And finally, how to prepare accounts from the trial balance. So let's look at closing off an account and bringing down the balance. Now, the balance on an account can be established at any time. Okay, can be established at any time. As the difference between the total value of the debit entries and the total value of the credit entries. Okay, the balance on account. So if you look at this account, for example, there's transactions on the debit side of the account. Is that not it? There are transactions here. Okay, there are transactions here. Okay, on the debit side of transaction. When you look at the trade payables, okay, there are transactions on the debit side of the trade payable and there's transaction on the credit side. Okay, good. So what we are saying here is that to close off an account, okay, to close off an account and bring down the balance. And we're saying the balance on account can be established at any time as the difference between the total value of entries of the debit can be established at any time as the difference between the total value of the debit entries and the total value of the credit entries. Good. Now, if the total debit entries in an account exceed total credits, there is a debit balance on the account. and if the total credit entries in an account exceed total debits, there is a credit balance on the account. Okay. When the balance on account is established at the end of the period, the process is described as closing off the account and bringing down the balance, though the same process is used whenever the balance is what? Extracted. The figure identified in this way is called the closing balance. It's called the closing balance. Good. Good. Now, the next thing is we have prepared the ledger account. Now, at the end of the year, or at the end of regular intervals, or say every 3 months, every 6 months, every year, there is a need for you to what? Close your books. Okay, there is a need for you to close your books. That is what is called balancing off an account. Okay, good. So now to balance off an account, you need to find the totals of your debit entries in the accounts and the totals of your credit entries in the accounts. Good. Now you then make the lesser side of the account equal to the bigger side of the account by introducing what is called a balance carried down, or what is called the closing balance. Okay, good. So now let's start. Let's look at how to balance off an account using the transactions that we just recorded. Good. So let's take note of the loan account. I want to do something quickly here. Okay, good. Let me bring the loan account here. The loan account here. On the debit side, that is 2018 of cash on the 20th of April of bank of 10,000. Then on the credit side, on the 15th of January of bank 40,000. Okay, that's my city side. Good. Let me then clean the top one so that make me for get some space to do my balancing. Great. So what is the loan account? Good. Of the debit, of the credit. Good. So to balance off an account, okay, quickly, let me grab my calculator. Okay. Great. So this is my calculator. I hope you can see it. Good. So now we are saying that to close off an account, you need to find the difference between the total of debit entries and the total of credit entries. Okay, good. Now, when the balance on the account is established at the end of the period, the process is described as closing off the account and bringing down the balance. Okay, good. The figure identified in this way is called the closing balance. Good. So how do we close? First, you need to total each side of the accounts. So let me project this one small. Good. Now, because you wouldn't know where the balance will be, it's advisable that you leave a line or two under each of the sides. Okay, and they should the balances when balancing, they should all be on the same line. So you can see that. Sorry. They should all be on the same line. So I come here, I leave a line here, a space under the 6,000, and come down. Good. Now I must the balances should be on the same line. So good. So let's total. In the bank account on the debit side, I have 30,000 plus 40,000 plus 12,000 plus 8,000. Now that gives me 90,000. So let me put it here. Debit 90,000. Now let me total the credits. I have 40 plus 5,000 plus 10,000 plus 10,000 plus 6,000. That gives me 71. Credits 71. So let me do the credit again. 40 plus 5,000 plus 10,000 plus 10,000 plus 6,000. That gives me 71. Good. And the debit is 30 plus 40 plus 12,000 plus 8,000. That gives me 90,000. Good. So you can see that the debit side is bigger. So here you use the bigger side total, okay, to balance the account. So when you come here, that will be the total for both sides. The bigger side, which is the side with the highest figure, okay, the highest figure should be the totals. So here the debit is 90, okay, and the credit is 71, but the lesser side must be made equal to the bigger side, so that they are the same. So here too, you have to put in here what 90,000, because the lesser side, which is the credit side, must be made equal to the debit. Good. And how do we do that? We do that by introducing what is called balance carried down. Good. And we are doing this balancing at the end of the period, because if you looked at our transaction was for a period ending 30th December. Okay, for 30th December. That's the first example. You're told that, okay, post the transaction to the ledger account. Good. We said that the following transactions relate to some interest for the year ended 31st 2018. Good. So we are doing this at the end of 2018. We are balancing off our accounts at the end of 2018. So to make the credit side, which is the lesser side, equal to the debit side, we put here 30th of December, balance carried down. Okay, so we find the difference between the debit side. The total was 90. So 90,000 minus 71,000, that gives us 19. So it means that the balance that needs to be added to the lesser side to equate the bigger side is 19,000, and that is what is called the closing balance. The closing balance, and that is denoted by balance carried down or balance carried forward. So we come here. Good. Good. So that is 30th of December, balance carried forward, and that is 19,000. Happy are together. Good. Good. So that is the balance, and you can see that when the 19,000 is added to the 71. So let's now total. We have 40 plus 5,000 plus 10,000 plus 10,000 plus 6,000 plus 19,000. So that gives us 90. So now you can see that we have 90 here, we have 90 here. Okay, but there was a difference. The debit side was bigger than the credit, and to balance it, you need to introduce the difference, and the difference that is termed as the closing balance. Okay, the closing balance. But because we will be bringing it down, that's why I've written balance carried down. Okay, so assuming we are going, if you have ended 2018, it means that the next period will be 2019. Is that not it? And we'll start our business from January of 2019. Is that not it? So you come down and say 1st of January 2019, balance brought down. Okay, 19,000. Some also say balance brought forward. Okay, BF, B/F. whichever you use is the same. Good. Good. Now let's look at the capital account. Now, the capital account has only one transaction at the credit side, and this must be made equal to the debit side. And what do we do? So here the difference or the closing balance should be what? 30,000 as well. Okay, because that is the difference between the credit and the debit. Now the debit must be made equal to the credit. And what is causing the difference? It is 30,000. So on 30th of December, you see balance carried down. Then you put the amount there, 30,000. Now here, because it's a single transaction, there's no need for me to draw this line, okay, and bring the 30,000 inside. Okay, there are no many transactions. So simply, I'll just underline it twice here for the sake of time. Under exam condition, you didn't have time to wear away like that. Okay, so I just come here and underline because they are all on the same line. So I close it. Okay, good. Now you can see the carry down is at the debit. Okay, so it needs to be brought down. So the brought down means it should come to the other side. Good. So that is 1st of January 2019. Balance brought down. Okay, and that is what? 30,000. Okay, good. Good. Now let's look at the van. Let's look at the van. Now the van is an asset, okay, and the debit side is more than the credit. So we have 40,000 here, and there's nothing at the credit side. How do we balance? Now we said that the credit side must be made equal to the debit, okay, or the bigger side must be made equal to a smaller side. And here the bigger side is the debit side, which is 40. So how do we make it equal? It means that we have to introduce our closing what? Balance. And so we have to do so by introducing the balance. So we come here and say 2018. So we say 30th of December, balance carried down. And that is what? 40,000. Okay, that is 40,000. So we underline it. We underline it. Okay. So we come to the next period. That is 1st of January. The 1st of January 2019, balance brought down of what? 40. I trust you are following. Good, good. Now we have the market store. The market store, that one too, the debit side is bigger than the credit. So the credit side is made equal to the debit side. So that too, we have to introduce our closing balance. Okay. So 2018, 30th of December, balance. Sorry, it needs to be 31st. December ends on 31st. So please don't forget 31st. Unless the 31st is a Sunday. Good. So it's 31st. Take note of that. So balance carried down is 5,000. Okay. So we have made it equal. The debit side has made equal to the credit side by introducing the closing balance. Good. So on the 1st, you see 1st of January 2019, balance brought down. That is what? 5,000. Good. Now let's look at the loan account. Let's look at the loan account. Now the loan account, you can see that we have on the credit side 40 and on the debit side 30. So the debit side must be made equal to the what? The credit side. So that one we need to bring it down a bit. Okay, good, 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 good. So now the bigger side is 40. So that will be the total for both sides because you are making the lesser side equal to the bigger side. Good. So what is causing the difference? There's a difference of what? 30. And that difference needs to be put here so that this agrees with that. So you come to this side, then on 31st of December, we introduce our balance what? Carry down of what? 30 what? 1,000. Okay. So we get 40. Sorry, let me use a different. So we have 40. We have what? 40. Okay, good. Then, so once the 30 difference has been identified, that is the closing balance. It's been added to the lesser side. So now we have 40, 40. Now on 1st of Jan 2019, our balance brought down is what? 30,000. It's 30,000. Good. So we are done with this side. Okay. So let's close the books on the other sheet. So we come here. Good. So you have purchases. Good. Now you can see that the purchases is an expense. So on the debit side, we have these figures. There's nothing on the credit side, but we need to close the books. So quickly, let me underline it. Now there's enough space here, so it should be on the same line. Now the total of this 18,000 plus 5,000, that should give us 23. So the total is 23. Okay. So this side too must be made equal. So the difference, what's causing the difference? The total is 23. There's nothing here. So to make the credit side equal to the debit side, you have to introduce your closing balance. And we do that by, so this is 2018. This is our CD sign. So you say balance carried down of what? 23. Good, 23. So on the 1st of January of the net ensuing year, this is the balance will be brought down. But don't forget to talk about something in the jiffy. Good. So let's look at that of sales. Let's look at that of sales. Good. So sales. Good. The total is 12 plus 9,000. That should give us 21. So we have 21,000, and this side is bigger than the debit, so it must be made equal. So we need to identify the difference. So the difference between the debit is still 21. So that difference is introduced by bringing our balance carried down of what? 21,000. Put the 21,000. So now it agrees. Good. Then on the 1st Jan 19 of the ensuing year, our balance brought down with what? 21. Good. Good. Now let's come to the trade payables. Okay, we have two transactions. So leave a line under each and underline them on the same line. So let's total. Now the debit side gives us what? 16,000. Debit is 16, and the credit is giving us what? 23. So the debit side must be made equal to the credit side. So we have 23,000. There should be 23,000 here. So what is causing the difference? There's a difference of what? 7,000, right? So 23 minus 16, that's 7,000. So bring the difference. That is 31st of December balance carried down, or the closing balance of 7,000. Then we come to 1st of Jan 2019 balance brought down, and that is 7,000. Okay, good. And we do same for the trade receivable. Now you can see there's 9,000 here and there's 8,000 here. So leave a line under each. Okay, and underline it. Now this is bigger, so this should be the total here. But here is 8,000. So we introduce the difference. So 31st of December balance carried down is what? 1,000. So on 1st of Jan 2019, our balance brought down will be 1,000. Good, good. So this is how to balance off an account or close off an account, and in bringing the balance what down. Good. Now let's note something. We said that when the balance on account is established at the end of a period, the process is described as closing off the account and bringing down the balance. Though the same process is used when a balance is extracted. Good. The figure identified in this way is called the closing balance. So what is seen as balance carried down, balance brought down, that is the closing balance. Okay, that is the closing balance. This is what we refer to as the closing balance. Okay, this is what is referred to as the closing balance on this account. Okay, this is the closing balance on this account. Okay, great. Now, we said that balances on expense accounts and income accounts are transferred to the statement of profit or loss. Note, there might be some accruals and prepayment on expense accounts. Okay, good. So what we are saying here is that at the end of the period, the balance that will be on the income and expense account will be used for the preparation of what? The statement of profit or loss what? Account. Good. Now, then the balances on the asset, liability, and capital accounts are carried forward as closing balances at the end of the period, and they become opening balances at the beginning of the next what? Period. Okay, good. So normally, when you are looking at an entity's records, but because this one you are preparing ledger accounts and want to know the balances on each, that is why we've closed off each of the balances and brought them down. However, in a practical sense, at the end of the year, the income and expense items, the difference will be to trading profit and loss. Okay, so that one straight, because you'll be working with an accounting system, the balances will find themselves, okay, transferred to the profit and loss account. But here we want to first extract a trial balance to see how the thing works. Okay, good. That is why you see the balances extracted. Good. So at the end, balances on income and expense account will be used for preparing profit and loss account. And the balances on assets, liabilities, and capital accounts are carried forward, okay, as closing balance at the end of the period and become opening balances at the beginning of the next period. Okay, because those items will continue. Assets, liabilities will be carried forward, but income and expense items expire within one accounting period. Do you get the point? Good. Now you get what I'm saying when we move on to our next session. Okay, good. So now this is balancing off. What we have done now is re-recording transactions in the ledger account, and we have also learned how to balance off the account. Good. Now after balancing off, what's next? Good. Let's see. Now, having balance of the account, you need to extract what is called the trial balance. The trial balance. So what is a trial balance? Now, a trial balance is a list of all the debit balances and all the credit balances on the accounts in the main ledger. Trial balance is extracted from the main ledger simply by listing balances on every account. The normal method of presentation is to present the balances in two columns. One for debit balances and one for credit balances. Okay, good. So Debit balances are assets, expenses, or what? Drawings. Okay, because it's we say that when an asset is increasing with debit, that should tell you that an asset has what? A debit balance. Okay, when a liability is increasing, we say what? We credit. That should tell you that a liability has a credit what? Balance. Okay, so the increase in item of the increase in the element of the financial statement tells you the balance that particular element has. So an asset, when it is increasing, you debit. Okay, when it is decreasing, you credit. Okay, so the increasing in the items or in the elements of financial statements, okay, is an indication of the balance that element has. I hope I've made myself clear. Because when an asset is increasing with debit, that should tell you that asset has a debit balance. When an expense is increasing with debit, that should tell you that the expense has what? A debit balance. When there is an increase in income or revenue, we do what? We credit. That should tell you that revenue has a credit balance. When a liability is increasing with credit, that should tell you that liability has what? A credit what? Balance. When there's an increase in owner's equity, or when the capital is introduced, okay, the capital introduction, if it is in the form of cash, it means that will cause an increase in cash. And what is causing the increase in cash? It is the introduction, which is termed as capital. So capital is what's credited. So it means that an increase in capital, okay, or when capital is introduced, it is credited, okay, and when capital increase, it is credited. So that should tell you that capital has a credit what? Balance. Good. So a trial balance simply means an extraction of the list of balances on an account. Okay, and we said that that is the best way of presenting is to have two columns, one for debit side and one for credit balance, one for the debit balance and one for the credit balance. Good. And we said that the debit balances are assets, expense, or drawings, and the credit balances are liabilities, income, and what? Equity, and reserve account in the case of a company. Good. Now, we are going to extract a trial balance very soon. But what is the purpose of a trial balance? Why do we prepare a trial balance? Good. Now we are saying that it is a starting point for producing a statement of profit or loss and a statement of financial position at the end of the accounting period. Because in our earlier slide, we mentioned that the balances on the income and expense accounts are used for preparation of what? Profit and loss accounts. And the balances on the capital, liability, and asset are used for preparing a statement of financial position. So it means that when a trial balance is extracted, okay, it serves the purpose of what? Preparing the financial statement. So we say that it's a starting point for producing a statement of profit or loss and a statement of financial position at the end of an accounting period. Good. Again, it is a useful means of checking for errors in the accounting system. Errors must have occurred if the total of debit balances and total of credit balances on the main ledger account are not what? Equal. Because you are going to extract a trial balance, we will record all the debit balances, we record all the credit balances. So what do you mean? Because we are observing, or that follows the double entry principle, we say that for every debit, there must be a corresponding credit. Then the assumption is that at the end of the day, the balances recorded on the debit side and the balance recorded on the credit side must all be what? The same. All right, so that is the purpose. So whenever you extract the balance and the debit is not equal to the credit, or the credit is not equal to the debit, then it means that there is an error, and the trial balance will help you to locate where the error came from. Because at the end of the day, your trial balance must agree. The debits must agree with the credits. So when you extract and there is an imbalance, it's what? It will pop up. Okay, so we say that it's a useful means of checking for errors in the accounting system. Okay, errors must have occurred if the total of debit balance and total of credit balances on the main ledger are not what? Equal. Good. So now let's look at from our account how to extract a trial balance. Good. So I come here. Okay, let me create a new page. Okay, so here we have sum. Okay, so we say try balance, try balance, try balance as at 31st of December 2018. Good. So I have my debit and I have my credit. Okay, so let me have my so I have my CD sign here. Good. Okay, so now we need to bring the balances on Sam's transaction. That is the transactions that we recorded in the ledger account. Afterwards, we closed off the books or we balanced off the books. So we must bring the balances on each account into the try balance. So let's look at how that is done. So I'll be moving here and there. So bear with me. Good. So I come back. So let's note. Now purchases has a debit balance of what? 23. Okay. Purchases has a balance of 23. Okay. Sales has a credit balance of what? 21. Okay. Trade payables has a credit balance of what? 7,000. And trade receivables has a debit balance of what? 1,000. So let me record the purchases. Purchases is 23 debits and sales is 21 credits. So come here, purchases 23. So I come here. So this is the description, the description of the item or the particulars. Okay. So I have purchases, and that was a debit balance of 23. Okay. And there was sales, and the sales was a credit balance of what? 21. Okay, good. Now I go back to look for the next entries. Okay, the next trade payables 7,000, trade receivables 1,000. So trade payables credit 7 and trade receivables is 1,000. So we have trade payables. It's a credit of 7,000. We have trade receivables of 1,000 debits. Good. Good. Let's go back. Okay. So if the bank account, the bank balance was a debit of 19 and the loan was a credit balance of 30. So bank debit of 19. So we have bank debit of 19 and loan credit of 30. Great. we have capital 30 credits, motor van 40 debits. So capital is a credit of 30 and van is a debit of what? 40. So we have van is a debit of 40. Okay, so capital is a credit of what? 30. Okay, and let's go back and bring the final. If there's any. Good. So we have store of 5,000 debits. Okay. So we have store of a debit of what? 5,000. Good. So these are all the transactions. So we total it. So let's see. Let's take the debit side. So we have 23, 1,000, 19,000, 40,000, 5,000. So this gives us 88,000. That gives us 88,000. So let's look at the credits. We have 21,000 plus 7,000 plus 30,000 plus 30,000. Sorry, 21,000 plus 7,000 plus 30,000 plus 30,000. That is also 88,000. Okay, good. So that's a trial balance. So assuming that this side didn't agree, that would have drawn our attention. So it will cause us to go back and look at where the error was. That's why we say that it is useful for checking what errors in accounting system. But at the end, because we kept proper records, okay, our transactions agreed at the end. Good. Now, after the trial balance has been extracted by a business, or at the end of an accounting year, after the business has balanced off his books and extracted the trial balance, what happens? Don't forget that we said that the income and expense items will be used for preparing what? The trading profit and loss account. And the assets, liabilities, okay, and equity will be used to prepare what? The statement of financial position. Good. So let's look at how to prepare an account. Preparing account from a trial balance. Good. Now we have what is called year-end adjustment. Yes, because there are instances where there may be few adjustments. Okay. Now a trial balance is extracted from a ledger, and the various year-end adjustments are then made to the account. Now these adjustments are covered in a later lecture, that is chapter 6 to 9, and they include adjustments such as depreciation expense, accruals and prepayments, bad and doubtful debts, and inventory. What are we talking about? Now, depreciation, right? Expense, for example, when an entity acquires an asset, we say that is a capital expenditure. And so most often than not, the business would really want to expense the asset purchase at a go. However, they capitalize this, keep it as an asset, and they write off the asset over its useful life. Okay, good. So as and when the asset is being used, the expectation is that the assets will wear and tear. Okay, so we are spreading this cost of the asset over the period of use. So that's the depreciation. Okay, good. And at times too, there will be what is called accruals and what prepayment. For example, there may be business expenses that maybe we have overpaid. Because normally in Ghana, when you are going for even someone's premises for rent for your business, the person will tell you, I don't want 1 year rent. Okay, I want 2 years. So maybe you will pay for 2 years. But having paid for 2 years, you have only utilized the thing for a year. Okay, so an financial statements are also prepared for a financial year. So it means that the amount that you have paid over and above, okay, what you should have paid for the year is termed as prepayment. It's an expense that you have prepaid because you are just making use of the premises for the year, okay, but you have paid for 2. So the excess amount that you have paid does not relate to the current accounting period. So in preparing your account, you need to make an adjustment for that, because if you include all the 2 years rent, then you'll be overstating your expenses. So where you have the 2 years rent, you need to deduct the 1 year from it, and the 1 year rent is termed as a prepaid rent. Okay, so you adjust for it when you're preparing an account for the current year. Again, there may be instances where the landlord say, okay, pay for say 1 year, but maybe you didn't have all the 1 year, so you paid for 6 months. However, you should have paid for 1 year, because we are looking at income for 1 year and expense for 1 year. We are matching the income of 1 year against the expense for 1 year. So if there was an expense that you should have paid that you didn't pay, there is the need for you to accrue it. There is the need for you to assume that had you paid, this would have been the true position. This would have been your true profit. So where you have expenses that are unpaid, which is they were expected to be paid in the current year, so you have to add what you have paid to what you were supposed to pay but have not paid. So that is accrual. Okay, you should have an expense for 1 year. You match revenue for 1 year against expense for 1 year. So if for any reason there is an expense that you should have paid for 1 year and you paid for some months, say 9 months, it means that the 3 months should be added so that you get to know your true reflection or your true performance, because the account is for a year. So you have to match revenue for 1 year against expense of 1 year. Okay, good. You will also make adjustments for items like bad and doubtful debts. Now, we know that most businesses carry out their business on credit. And as far as you're doing business on credit, there is a risk that some customers may not pay, and therefore some of your debts may go bad. So when you talk about a bad debt, it is a debt that is not collectible. Okay, now it means that you would have chased for that debt, and it has proven futile. Okay, now in accounting, okay, there are legal processes that you have to go through before you can declare a debt to be bad. For example, you should have chased the person, and there should be proven record that maybe the person is bankrupt, the person is insolvent, or the person has died. There is no successor, and or even if there is a successor, the successor is not liquid enough to be able to pay the debt, and so you can't keep keeping that debt in your books. So you need to take it off your books. That is where to stem as bad debt. Okay, a debt that is not collectible. So at a point when there are all indications that the amount cannot be collected, then the business needs to write it off its books. Okay, good. Now, and there's debts that are doubtful. Now, doubtful debts are debts that there is a presumption, or there is the perception that they may not be collectible. Now, in accounting, there is the need for one to be prudent. Okay, the prudent concept. Now we'll talk about these things. Okay, you need to act prudently in the sense that now, if you have debtors, now you have to have the assumption that some of them will not pay. Okay, and so some of the debts are doubtful, and you make provision for them. Okay, so when we come to bad and doubtful, then we will show a clear distinction between what is bad and what's doubtful. Doubtful does not mean that it is bad, but that you are just making room or an allowance should they go bad. Okay, good. Then we'll also make adjustment for inventory, because as you buy goods, okay, as you buy goods, they come. So when you buy, they are purchases, but as you get hold of them, they come into your inventory account, because you'll be holding stock, and therefore you have inventory. So at the end, you have to make an adjustment. How many quantities of goods did I buy? At what price? What is the value of the inventory? How many quantities, or how many have I sold? And the ones I've sold, what is the cost? Therefore, what is left? And what is the value assigned to that value of inventory? We'll be looking at these discussions, okay, later in a later lecture. Good. Now, further adjustments are made as necessary to deal with items mixed or incorrectly dealt with during a period. So where there are also omissions of transactions, you need to correct them. You need to bring them in. Okay, good. Now, when year-end adjustments have been made, a statement of profit or loss, and then a statement of financial position can be prepared using the adjusted what? Balances. Using the adjusted what? Balances. Good. Good. So there may be adjustments. Now let's look at opening and closing inventory and the cost of sales. Now don't forget that we have looked at this under the accounting equation. We dealt with this. Okay, good. Now, but let's look at how it was opening and closing inventory and the cost of sales. Now, cost of sales in the statement of profit or loss is not the cost of goods purchased or cost of goods produced. It must be the cost of the goods sold. Now, the accruals or matching concepts must be what? Applied. When there are differences between the quantity of materials purchased or made and the quantity of materials used or sold, there is an increase or decrease in what? Inventory during the period. So to determine cost of sale, because when goods are sold, you need to determine the cost of it so that you match the sales value against the cost of those goods. Okay, so the formula for calculating cost of sales is that if you have an opening stock, you add your purchases to it. When you add your purchases to your opening stock, you get to know the total quantity of goods that you have to sell. Okay, then at the end, you would have sold some of the goods. So what is the quantity of goods left and what is its value? Now you have to less the value of goods left from the total goods that you had to sell, and that will give you the cost of the goods that you have sold, properly known as what? Cost of what? Sales. Good. So we say that, note, the addition of opening inventory and purchases presents the total cost of goods available to be what? Sold. The closing inventory represents the total amount of goods still held at the end of the period. So the closing inventory represents the goods purchased that have not yet been what? Sold. Good. Good. So that's the cost of sales. So let's look at how to prepare a simple trading profit and loss account. So we say prepare the statement of profit and loss account for 6 months and the 30th June 2018 and the statement of financial position as at what? The date. Good. Now we know that statement of profit or loss. We are looking at the statement of profit or loss. Good. So let's see. So this is our trial balance. Again, we could also use this to prepare our trading profit and loss account. So quickly, let me use this one. So let me go back. So let me use Sum Limited. Okay. Good. So Sum. So I have the statement of profits or loss for the year ended 31st December 2018. Good. Okay, good. Good. So here I have my sales. Now from the question or from our trial balance, okay, what was our sales? Our sales was what? 21 what? Thousand. Was 21 what? Thousand. Okay, it was 21,000. So let's look at it. Let's look at our sales. Sorry, give me a second. Let me make use of this rather so that it will be much clearer. Okay, okay, good. All right, hold on. Good, good. So let's make use of this instead so that I can have the question side by side so that I can have an appreciation. So this is a trial balance extracted. This is a trial balance. Dodua began trading on 1st January 2018. The following information has been extracted from his accounting records as at 30th June 2018. So we have sales, purchases, salaries, operating expenses. So these are transactions, right? We have inventory at 30th June 2018 was this. Required, prepare statement of profit or loss for the 6 months ended 30th June 2018 and a statement of financial position as at what? That date. Good. So because I have this side by side, that will rather be helpful. So please indulge me to use that instead. Good. Great. So we have Dodua. Okay. So we have to prepare the statement. We have to prepare the statement of profit or loss for the 6 months ended 30th of June 2018. Okay. So what do we need? We have our sales. We have our sales. So sales is what? 184,620. Good. Now from this question, I don't see any returns because it's possible that you sell goods and some of the customers will return it. When they return, you need to deduct it from the sales. But in this trial balance, I don't see any returns. So I move on to let's cost of sales. Okay. Now, how much did it cost us to sell these goods valued 184,620? Good. So that is why we learned the concept of opening and closing and the cost of sales. Good. So we come here. So is there any opening stock? No. But I see inventory at 30th June 2018. That happens to be the closing inventory. But I can see that we have purchases. So opening inventory is dash. I have purchases. So I add my purchases. I have my purchases. And the purchases is what? 146,290. Good. If there were carriage inwards, that is the amount of cost incurred in transporting the goods to the business premises, you would have added. But in this trial balance, there is none. So it means that when we add opening plus the purchases, we get still 146,290. This is the cost of goods available for sale probably known as cook gaps. Cook gaps. Cost of goods available for sale. Cost of goods available for sale. Okay. All right. Cost of goods available for sale. Cook gaps. Good. Amount is 146,920. Good. Now, at the end of the period, were you having any stock of goods left? Because you had the total goods worth 146,290 to sell. Now, were there any inventory of goods left at the end of the period? Yes, because you are told that inventory as at 30th June 2022 was what? 25,480. So it means I have to deduct it from the goods that we had to sell. And the difference represents the cost of goods that we sold. So we come here and say less closing inventory. The closing inventory is 25,480. Great. Now, when that is deducted from this, what do we get? So I have my calculator here. 146,290 minus 25,480. That gives me 120. That gives me 128,10. Good. Good. Now, we deduct this from that because we have sold goods. We are comparing the cost of the goods sold to the amount we realized from the sale of that goods. Good. So the difference is what is termed as the difference between sales and cost of sales is what is termed as what? The gross profit. The gross profit. Okay, gross profit. And that is 184,620 minus 128,10. That gives me 63,810. Okay. So we have 63,810. Good. Good. Now we need to deduct our expenses. So the difference between sales and cost of sales is what? Gross profit. Okay, is the gross profit. It means that we sold goods costing 120,810 for 184,620. That is remarkable because it means that we have added our profit margin to it. Okay, good, because the goods actually costed 120,810, but we sold it for 184,620, and so the difference is what is termed as what? Gross profit. Good. Now let's deduct our expenses. Now, assuming there were other income, okay, maybe discount received, maybe if you have disposed some assets would have added, but that is for an advanced level. This time we are just looking at how to prepare simple profit and loss statements. Good. So there is no other income. So it's just from our trading activities. Okay. Good. Profits from our trading activities. So we less our operating expenses. Good. Good. So let me look at less operating expenses. Good. So let's go through our trial balance. We have purchase, we have salaries. So let's note down that we have salaries. And what's the amount? 21,500. We have motor expenses. Motor expenses of 5,200. We have rent. We have rent of 6,700. We have insurance of 1,100. We have what general expenses of what 10 and 50. Good. General expense of 10 and 50. Good. So let's see. So we have 21,500 plus 5,200 plus 6,700 plus 1,110 plus 1050. That gives us 35,560. 35,560. So the difference is what is called our net profit. Our net profit. When you take expenses from your gross profit, you get your net. Okay, good. And that is 63,810 minus 35,560. And that gives us 28,250. Okay, good. Good. So this is the statement of profit and loss for Dodua. Good. The next thing for us to do was for us to prepare what? The statement of financial position. And we know that the statement of financial position contains the list of the assets and the liabilities and equity of what? The entity. Good. So let's quickly look at how to prepare the statement of financial position as well. Good. So we have all the transactions here. So again, we have Udua. Okay, always the name of the company is very important. Then what you are preparing. So you are preparing statement of financial position as at 30th of June 2018. Good. So I have my assets. So I have my assets. So here I have to list all my assets. So let me see the asset I have. I have premises, I have motor vehicle, I have cash. So I list them. Premises is an asset, and it is 15,000. Then I have motor vehicle, also 12,000. I have okay, so I have this assets. Okay, so let me list all the assets. Okay, good. Or for purposes of proper presentation, we know that for assets we have what is called non-current assets and current assets. Okay, non-current assets is what is called fixed assets, or we used to call fixed assets. Okay, now it is even termed as PP, but for the purpose of this simple presentation, let me use non-current assets. Okay, good. So non-current assets. Good. Non-current assets. And we have the non-current assets. We have premises, motor vehicle. Good. So let me add. This gives us 27,000. Good. Then I then list my current assets. That is assets that are that's exhaustible within one accounting period. Okay, good. Benefits the company for 1 year. Okay, that is current assets. Okay, so a typical example of such assets are what we have: inventory. We have inventory. That is the inventory at the end of the period. It represents your assets. So here the inventory at the end was what? 25 480. So we have 25 480. 25 480. Then we have trade receivables. Trade receivables. And the trade receivables is 19,500. 19,500. Okay. Then we have cash. We have cash of 16,940. Great. So when we add this, what do we get? We have 25,480 plus 19,500 plus 16,940, and that gives us 61,920. 61,920. So let's add and see our total assets. So this will give us our total assets. So this plus 27,000 gives us 88,920. Good. Now the whole of this operation is financed by, so we have our capital. Okay, we have capital, and the capital of the business was what? 54,240. So we have 54,240. Good. Now, when we traded, we made a profit. And don't forget that we learned in our earlier discussion that profit is an addition to capital. So we say add net profit of what? 28,250. Good. Now, again, we have drawings, and we also learned that drawings also cause a movement in the owner's equity. So that's a reduction. Good. So we less drawings. We less drawings. We less the drawings. And that is 8,950. Okay, good. So let's look at the resultant figure, because we've added, we have 54,240 plus 28,250 minus 8,950. That gives us 73,540. 73,540. Okay, and we have trade payables. Trade payables. So that's our liabilities. That's the current liabilities. Our current liabilities. That is trade. That is trade payable of 15,380. Good. So let's add that one and see. Let's add that one and see. So 73,540 plus 15,380. That also gives us 88,920. So you can see that our balance sheet has also agreed, because we have 88,920 here and you have 88,920 here. So this is how to prepare a simple statement of profit or loss and the statement of financial position. Don't forget that we have learned earlier that the statement of profit and loss indicate the performance of the business over a period of time, whereas the statement of financial position indicates the wealth of the company at a point in time. Great, good. So this is how to prepare a simple statement of profit and loss and a statement of financial position. Good, good. Now let's look at other things. So there are other trial questions here in our interactive session. We'll try and solve more. Good. Now let me look at what is called the general journal. The general journal. Now, journal entries. So here the focus is to look at how to make journal entries, okay, to record transactions. Good. Now, journal entries, or the general journal, simple put as journal, is a book of prime entry that is used to record transactions that are not recorded in any other book of original entry. So the general journal is a book of prime entry that is used to record transactions that are not recorded in any other book of original entry. Now, the journal might be used to provide a record, an explanation of one, posting from books of prime entry, which we'll look at in our next chapter. Year-end adjustments can be made through a journal. We can correct errors through a journal, and any other adjustments, okay, could be made through journal, because adjustments do not have books into which we record. So any transaction, okay, where there is no book of original entry or a subsidiary book to record it in, it is recorded in a journal. Okay, good, good. So how do we make journal? Now the format of a journal entry is as follows. Now it follows a format just like the trial balance. Okay, so that one, a journal will have a debit and a credit. So the transaction that needs to be debited must come first, and the transaction that needs to be credited follows. And when you are done, you tell a story. What have you done? You narrate it. So maybe if it is cash sales 5,000, it means that you need to debit cash 5,000 and credit sales 5,000. Then you indicate that this is a cash sale. Good. So let's look at it. Let's see whether we have any example to use to record said transactions. Okay, so let's use that of the Sam Enterprise to learn how to record journal entries. Good, good. Good. So we have Sam Enterprise. Okay. So we have journal. So we have journal entries. Yeah. Then we have the debits, then we have the credits. Okay. Okay, so the first transaction, Sam decided to set up a business selling football shirts from a store in the marketplace. He begins by introducing 30,000 into the bank account for the business. So here, let's have the particulars or description or details. Okay, good. So we record the transaction. So the first thing is that he begins by introducing 30,000 into the bank account for the business. So here we are going to debit bank with 30,000 and credit what? Capital. Okay, also with 30. Okay, then when you are done, you narrate. What have you done? Being capital introduced. Okay, this is how to pass a journal. Okay, good. So that ends the first transaction. Okay, so that is the January 1st. Now the next thing is January 15th. January 15th says that Sam borrows 40,000 from his brother to purchase a van for the business. So here, now Sam borrows 40,000 from his brother to purchase a van for the business. Good. So here it is fourfold because he borrows, so the money will come in. So we say bank will be what? 40. Then there's a loan because he's going to borrow 40,000. Okay, good. Now on this same transaction, now he uses the money to buy a van. So there will be a motor van of 40, and again we credit bank with what? 40. Okay, and the narration will be being amount borrowed to buy a van. Okay, good. So the next transaction, Sam buys a market store and pays 5,000 in cash. So the store buys a market store, so there will be an increase in asset store. So you see store 5,000. Always the debit entry must come first. Then since he paid for it, bank, there will be a decrease in bank also of 5,000. So being store purchased. Okay, good. Now let's continue from here. Sam buys some football shirts for 18,000. These shirts were bought on credit. Okay, good. So we have purchases. Sorry. So we have purchases of 18. Okay, when you buy, who's for resale, or when you buy your trading item, it denotes what? Purchases. Good. And they were bought on credit. So the next entry is to the trade payables account. Okay, that is also 18,000. Being goods bought on credit. Okay. So let's see. Being goods bought on credit. Okay, good, good. Now let's see the next transaction. Sam pays 10,000 to his suppliers for some of the shirts he purchased. So on payment, there will be a decrease in asset cash. Is that not it? And there will be a decrease in liability. That is payables. Is that not it? Good. So when payables are reducing, payables have a credit. So when they're reducing, we debit. So we say trade payables. The amount is what? 10,000 Ghana cedis. Then bank is also 10,000 Ghana cedis. So here the narration being payment to suppliers. Okay, good, good. Now let's look at the next. The next. Sam sells 50% of the shirts for 12,000 in cash. Okay, good. So here he sold some shirts for 12,000 in cash. So there has been sales and there has been receipt of cash. Good. So we say bank 12,000, then sales 12,000, then sale of so you will say being sale of goods for cash. Good. So this is how journal entries are what are passed. Okay, this is how journal entries are passed. Okay, so you can record journal entries for every single what transaction. For every single transaction. Good, good. Let's continue. Okay, let me try and pick another sheet so that we can continue from there. Good. Okay. So we have our debits, we have our credits. Okay. Good. Great. So on the April 8th, April 8th, of April 8th, We say that some sell shirts for 9,000 to a shop owner another time. These shirts originally cost 5,000. He sells the shirts on credit, giving the purchaser 1 month to pay. Okay, so this is a sale on credit. Okay, good. So since it's on credit, there'll be trade. So I have trade receivables of 9,000, and I have sales of what, 9,000. Paying sales on credit. Okay, good, good. Now let's look at the next. Some pays 10,000 of the loan. Good. So once there's a loan repayment, there'll be a reduction in the loan. Okay, and there'll be a reduction in our bank account as well. So when bank is decreasing, it's an asset. When it is decreasing, we credit, and the loan is a liability. And when liabilities are decreasing, we debit. Okay, so we say loan 10,000 and bank 10,000. What has happened? We have repaid. So being loan repayment. Okay, being loan repayment. All right. All right. The next, some pays his trade supplies 6,000. So when some pays his trade supplies, it's a liability account. So when we pay them, it means that we are reducing our indebtedness to them. Okay, and it means that cash will be going out. Good. And when an asset is decreasing, we credit. And when a payable or a liability is reducing, we debit. So we say trade payables 6,000 debits. Then our bank account will reduce also by 6,000. So being payment to suppliers. Okay, good. Being payment to suppliers. All right. The next transaction is that Sam receives 8,000 of money owed to him by the customers. So here there's money coming in, there's cash coming in. So when an asset is increasing, we debit. Is that okay? And the trade receivables have paid us, so their indebtedness to us will reduce. Good. So here we come here, we say bank we have bank 8,000. We have trade receivables. Trade receivables also reducing by 8,000. So being cash received being cash received from customers All right. So receive from the customers. Okay, great. So basically, this is how to generalize entries or accounting what? Transactions. Accounting transactions. Great, great, good. So prepare journals for each of the above. So that's what we have done. Okay, so basically, this brings us to the end of our chapter 4. Okay, the double entry bookkeeping. Okay, so you have learned how to record transactions in the ledger account. We've looked at how to balance off an account, and we've looked at how to extract and try balance, and how to prepare basic financial statement from a try balance. And finally, we ended by learning how to generalize entries. Good. I implore you to make use of the Institute manual. There are a number of questions in there. We have the question bank there. Okay, good. Now, on this topic, we will try and solve some more questions on this. Okay, in our interactive section. Okay, I will take a more detailed question, learn how to enter them in the various ledger accounts, balance them off, and extract a try balance. Okay, then we look at other transactions and to generalize, to enhance our understanding. Please solve more questions. Solve more questions. Solve more questions. Okay, the question bank is there. That's the Institute question bank. I will also be supplementing it with some other questions. Okay, so kindly make time, sit down and practice more. And I believe at the end of the sitting, you will come out victorious. Okay. Feel free when you go through the lecture notes. If you solve some questions and any challenges, note them down. At our interactive session, you can ask your questions and I'll address them. Do have a lovely day.